Investing in individual stocks provides investors with incredible opportunity when it comes to investment returns. Sometimes, even a very small investment in one stock is all it takes to become incredibly wealthy. However, like any investment strategy, there are both advantages and drawbacks to consider, but if you decide to take on the challenge, the reward could be life-changing. Take a look at the good and bad of investing in individual stocks and watch to the end to see how you can be exposed to the incredible potential of stocks with long term growth and stability. By far, the most exciting aspect of investing in individual stocks is the potential for incredible returns. History has shown that certain stocks can experience exponential growth, leading to impressive returns for early investors. In fact, even mature companies can provide market-beating returns, lining the pockets of its investors. Those with the foresight to buy in prior to a period of growth sometimes amass large fortunes. For example, those who invested in tech giants like Amazon, Apple, and Google during their early stages have witnessed exponential growth in their investments, far outpacing the overall market. An investor who piled $10,000 into Apple stock back in the year 2000 would be sitting on over $2 million as of June 2023. This example is somewhat of an anomaly, but it's possible and common to make excellent returns by investing in lesser-known stocks or companies that aren't one of the world's largest. The potential for high returns remains a major draw for investors seeking to outperform the broader market to achieve financial freedom. Unlike passive investment strategies where investors delegate the management of their funds to professionals, owning individual stocks allows investors to have a direct say in where their money goes. Being actively involved means conducting in-depth research, analyzing financial statements, evaluating company fundamentals, and staying up to date with market trends. This hands-on approach empowers investors to make informed choices based on their own analysis and beliefs. Active involvement can instill a sense of ownership and accountability as investors become personally invested in the success of the companies they hold. For those who enjoy the intellectual challenge and engagement that comes with stock picking, being actively involved can be a rewarding aspect of investing in individual stocks. Buying single stocks can create a unique emotional connection between investors and their investments. Unlike investing in impersonal funds and ETFs, owning shares of individual companies can evoke a sense of pride, loyalty, and even a feeling of being part of something bigger. Investors might develop an emotional attachment to the companies they invest in, especially if they admire the brand, the product, or the vision of the company's leadership. For some investors, this emotional connection might be driven by their admiration for the brand, product, or services offered by the company. They might have a personal affinity for the company's values, mission, or contribution to society. This emotional attachment can create a genuine interest in the company's growth and success beyond just financial returns. This emotional connection can lead to a long-term perspective, as investors are more inclined to weather short-term market fluctuations and stay committed to their chosen companies. This can instill a sense of purpose and engagement in one's investment strategy, making the process more enjoyable and rewarding. Unlike diversified investments, individual stocks are more susceptible to company-specific risk, market volatility, and unexpected events. One piece of bad or good news can cause unimaginable price swings, which may or may not be justified as the market often reacts emotionally. The future of a single company can be heavily dependent on factors such as financial performance, competition, leadership, industry changes, and economic conditions. This can lead to significant price fluctuations, and in some cases, even the total loss of investment. Smaller companies and those in emerging industries can be especially vulnerable as they lack the stability and resources of more established firms. Even large and established companies are subject to disruptions that could completely alter their future. Just take a look at the history of companies like JCPenney, Blockbuster, and Toys R Us. Unlike investing in diversified funds which hold a basket of stocks across various industries and sectors, individual stocks concentrate an investor's money in a limited number of companies. This lack of diversification exposes investors to a higher level of risk because the fortunes of their entire portfolio become heavily dependent on the performance of a few companies. If any of these individual stocks face financial challenges or experience a decline in their stock price, the overall portfolio can suffer severe losses. Just imagine an investor has half of their portfolio in one single stock. What if the stock price is cut in half or the company goes under? Diversification is a fundamental risk management strategy that helps to spread risk and protect against the potential downfall of any single investment. Successful stock picking requires extensive research and analysis. Investors need to dedicate significant time to assess companies thoroughly and identify potential winners. This constant analysis demands ongoing commitment and expertise. For investors with limited time or experience, it might be challenging to conduct thorough research consistently. Moreover, the investment landscape is constantly evolving, requiring investors to stay informed and adapt their investment strategies accordingly. Investing in individual stocks is synonymous with volatility, and it's like riding a financial roller coaster. Stock prices can swing wildly on a daily basis due to various factors, such as company performance, economic conditions, geopolitical events, and investor sentiment. This volatility results in significant price fluctuations, sometimes without any apparent reason. While this unpredictability can present opportunities for rapid gains, it also brings the risk of substantial losses. Investors need to brace themselves for the emotional ups and downs that come with the territory. The key to navigating the volatility of individual stocks is to stay focused on long-term goals and avoid making hasty decisions based on short-term market movements. It's essential to remember that volatility is an inherent part of the stock market, and successful investors need to learn to embrace it as a part of their investment journey. Investing in individual stocks can trigger emotional decision-making. Emotional biases, such as holding onto underperforming stocks due to attachment or selling winners prematurely out of fear, can negatively impact investment returns. Emotional discipline is crucial to maintaining a rational and objective investment approach. Investors must be aware of these biases and implement strategies to manage emotions effectively. Developing an investment plan, setting clear goals, and periodically reviewing and rebalancing the portfolio can help minimize the influence of emotions on investment decisions. Investing in individual stocks can be a roller coaster ride of emotions, and stress is an inevitable part of the journey. The daily fluctuations in stock prices, market uncertainties, and the fear of potential losses can cause anxiety and sleepless nights for investors. The pressure to make well-timed decisions and the fear of missing out on potential gains can lead to impulsive and emotionally driven actions. Additionally, the constant need to stay updated with market news and company developments can be mentally taxing, especially for investors with limited time and resources. Stress can cloud rational judgment, leading to mistakes and regretful choices. Investing 80% of a portfolio in ETFs and 20% in single stocks can be a well-balanced approach. The 80% allocation allows investors to participate in broad market growth. On the other hand, the 20% allocation to single stocks adds an element of selectivity and potential for higher returns. Investors can handpick companies they believe in, align with their values, or have strong growth prospects. Combining ETFs with individual stocks can strike a balance between passive and active investing, offering the best of both worlds while minimizing risk and maximizing potential rewards. While some individual investors have managed to achieve impressive returns and outperform the market in certain periods, doing so consistently over the long term is a challenging task. Beating the market requires not only a keen understanding of financial markets, but also the ability to make well-timed and informed choices. Research and studies have shown that the majority of professional fund managers who are experts in the field struggle to consistently outperform the market over extended periods of time. For individuals with limited time, resources, and expertise, the odds of consistently beating the market are even more daunting. While there are instances of successful market beating, the best approach for most individuals is to focus on creating a well-diversified and balanced portfolio that aligns with their financial goals and risk tolerance.